There is an industry that collects money from you every single month for a product you desperately hope you never have to use. And the business model only works if you don't use it. Think about that for a second. You are paying a company every month, for years, sometimes decades, for a service whose profitability depends on that service never being delivered. That is not insurance. That is a subscription to a promise, written in a font size designed to be ignored. And when the moment comes, the moment you actually need it, the car crash, the cancer diagnosis, the disability, the house fire, the company that has been cashing your checks for 11 years is suddenly going to read the fine print with a level of precision they have never once applied to depositing your premium. Welcome to the American insurance industry, a $1.4 trillion per year business built on one foundational insight. Most people will pay for protection they will never be allowed to collect. Let's start with health insurance because it is the most personal, the most emotionally loaded, and the most systematically broken. The United States spends more on healthcare per capita than any other developed nation on Earth. We spend approximately $13,000 per person per year. The next closest country, Germany, spends about $7,500. And despite spending nearly double, American health outcomes rank below most peer nations on life expectancy, infant mortality, chronic disease management, and basically every metric that suggests the money is doing something useful. So where is the money going? A significant portion of it is going to a layer of the system that exists in almost no other country on the planet. Private health insurance companies sitting between you and your doctor, collecting premiums, denying claims, and employing entire departments whose sole function is to find reasons your medically necessary treatment doesn't qualify for coverage. This department has a name. It is called utilization management. And utilization management is the corporate euphemism for a team of people whose job is to say no to your doctor. Your cardiologist recommends a procedure. Utilization management reviews it. They are not cardiologists. They are reviewers with checklists. And statistically, the more claims they deny, the better the company's loss ratio looks to Wall Street. The loss ratio is the percentage of premiums paid out in claims. A lower loss ratio means more profit, which means in the health insurance business, every denied claim is a better quarter. Every rejected prior authorization is an improved earnings report. Every letter saying your treatment is not medically necessary is a line item that makes shareholders happy at the exact moment. It makes you terrified. Now, let's put a number on the denial problem. The Kaiser Family Foundation analyzed data from the Affordable Care Act marketplaces and found that insurers deny approximately 17% of all in-network claims. 17%. Nearly 1 in 5 claims denied on policies that people are actively paying for, and of those denials, fewer than 0.2% are ever appealed. Not because the denials are correct, because the appeals process is deliberately exhausting, deliberately confusing, and deliberately designed to outlast the patience of a sick person who is already dealing with being sick. The industry knows this. The math works in their favor. Deny the claim, most people give up. The ones who don't give up fight through the process and occasionally win on appeal, but that is a rounding error against the volume of silent surrenders. Let's meet someone who lived this. Meet Angela. Angela is 41. Angela has employer-sponsored health insurance. She pays $480 a month in premiums. Her employer pays another $900. Total monthly premium, $1,380 for a family of 3. That is $16,560 per year going to her insurer before a single claim is filed. Angela's son needs an MRI. Her pediatrician orders it. The insurer requires prior authorization. Prior authorization is a process where the insurance company decides whether to agree with your doctor's medical judgment in advance. The authorization is denied. Wrong diagnostic code. Angela's doctor resubmits with the corrected code. Denied again. The MRI facility is out of network. Angela finds an in-network facility. The authorization is resubmitted. Pending 3 weeks pass. Angela calls the insurer. She is transferred 4 times. She is on hold for a combined 2 hours and 40 minutes over 2 days. The authorization is finally approved, 6 weeks after the pediatrician first ordered it. Angela's son gets the MRI. The bill arrives. The insurer covers 70% after the deductible. Angela's deductible is $3,000 per person and $6,000 per family. She has not met her deductible yet. She owes $1,400 out of pocket for a test. Her doctor said was necessary, after paying $16,560 in annual premiums for the privilege of this experience. Angela is not an edge case. Angela is the median American healthcare consumer navigating a system that is functioning exactly as designed. Now, let's talk about the design, because the design is the story. The prior authorization system processes approximately 300 million requests per year across the American healthcare system. The American Medical Association surveyed physicians in 2023 and found that 94% reported that prior authorization caused delays in necessary care, and 33% reported that prior authorization had led to a serious adverse event for a patient in their care. A serious adverse event. That is medical language for something went badly wrong because the paperwork took too long. People are being harmed by the administrative architecture of an industry that collected their premiums without delay and then installed a bureaucratic obstacle course between them and the treatment they paid for. And the most extraordinary part is who is doing the reviewing. In 2023, a ProPublica investigation found that one major insurer's algorithm was automatically denying claims with an average physician review time of 1.2 seconds per case. 1.2 seconds less time than it takes to read the patient's name. Artificial intelligence and automated decision systems are being used to deny coverage at industrial scale, while the humans whose claims are being denied spend weeks navigating appeal processes designed to outlast them. Now, let's shift to life insurance, because the structure of the scam looks different there, but the underlying mechanics are the same. The life insurance industry sells two primary products: term life insurance, which is pure death benefit coverage for a fixed period, and permanent life insurance, which includes whole life, universal life, and various hybrid products that combine a death benefit with a savings or investment component. Term life is straightforward and reasonably priced. A healthy 35-year-old can get a 20-year $500,000 term policy for around $25 a month. It does what it says. You die during the term, your family gets the money. Clean, transparent. Competitive permanent life insurance is a different story. Bubble whole life insurance is consistently one of the most aggressively sold and most frequently regretted financial products in America. The pitch is elegant. You get lifelong death benefit coverage. Your premiums build cash value over time. That cash value grows tax deferred, and you can borrow against it or surrender it later. Death benefit plus savings vehicle plus tax advantages sounds like a 3-for-1 deal. Here's what the pitch leaves out. The fees embedded in whole life policies are extraordinary. A significant portion of your early premium payments go to commissions. The commission on a whole life policy can be 50 to 100% of the first year's premium, which means if you pay $5,000 in your first year of premiums, up to $5,000 of that may go directly to the agent who sold it to you. Your cash value in year one, close to zero. And the internal rate of return on the cash value component of most whole life policies, if you hold them long enough to break even, is typically between 1% and 3.5%. The S&P 500 has averaged approximately 10% annually over the last 50 years. The standard financial planning analysis consistently concludes that for most people, buying term and investing the difference produces dramatically superior outcomes to permanent life insurance. But term insurance pays the agent $25 a month in commission. Whole life pays them $5,000 in year one. The incentive is not subtle, and yet whole life is sold relentlessly, every year, to people who are told it is a sophisticated wealth building tool used by the wealthy to transfer assets tax efficiently. Sometimes that is true for a very specific category of high net worth individual with a very specific estate planning need. Whole life has legitimate applications. For the median American family being sold a whole life policy at their kitchen table by an enthusiastic agent who just passed his licensing exam, it is an overpriced product with embedded costs that would be illegal in any other investment context without full disclosure. Now let's talk about disability insurance, because this is the one nobody thinks about until it is too late. The Social Security Administration estimates that a 20-year-old worker has a 1 in 4 chance of becoming disabled before reaching retirement age. 1 in 4. Not a fringe risk. A coin flip with worse odds. And yet disability insurance is the most underowned and most misunderstood coverage in America. Most people assume workers' compensation covers disability. It covers work-related injuries only. Most people assume Social Security disability covers them. The average Social Security disability benefit is $1,537 per month. The application is denied on the first submission roughly 67% of the time. The average time from application to approval, if approved, is over 2 years. 2 years without income while you are disabled and appealing a government decision. Private disability insurance exists to fill this gap. And private disability insurance has its own fine print problem. The most important distinction in any disability policy is the definition of disability. Some policies define disability as being unable to perform the specific duties of your own occupation. If you are a surgeon and you injure your hand, you cannot perform surgery. You are disabled. You collect benefits. Other policies define disability as being unable to perform any occupation for which you are reasonably qualified by education and experience. Any occupation. If you are a surgeon and you injure your hand, but you can teach medical school, you are not disabled. Claim denied. This single clause, buried in a policy document that averages 40 pages of dense technical language, is the difference between collecting your benefit and being told you should go find a different job with your non-functioning hand. And insurers know which definition sells better and which definition pays out less. The any occupation definition is cheaper as a product, and cheaper products sell more easily at the kitchen table. So the product that gets sold most aggressively is frequently the product that pays out least reliably. The mechanism is consistent across every category of insurance. Collect premiums from as many people as possible. Make the policy language complex enough to create ambiguity at claim time. Deploy that ambiguity in favor of denial. Design the appeals process to maximize abandonment. Repeat at scale until the quarterly earnings call. This is not illegal. It is the business model. And the business model is protected by the same regulatory structure that is supposed to constrain it. Because state insurance regulators are chronically underfunded, frequently understaffed, and occasionally staffed by former industry employees who return to the industry after their regulatory tenure. The revolving door between insurance regulation and the insurance industry is not a secret. It is a career path. So where does that leave you? Read the exclusions before you buy anything. Not the summary, the actual policy document. The exclusions section is where the product reveals what it has decided not to cover. Pre-existing conditions, specific procedures, certain diagnoses, specific timeframes, specific facilities. The exclusion section is the honest version of the policy. Everything else is marketing. If you are denied a claim, appeal immediately. The industry counts on abandonment. The appeal success rate for health insurance denials that are actually pursued is significantly higher than the initial denial rate suggests. Most denials are overturned on appeal. Most appeals are never filed. File the appeal if you have a disability policy. Read the definition of disability before you need to use it. Own occupation is better. If your policy says any occupation, you need to understand the gap before you are in it. And if an insurance agent is spending more time on the commission structure than on the exclusions, that is telling you something. The product that is best for you and the product that is best for them are frequently not the same product. And in an industry with this much fine print and this little transparency, the distance between those two products is measured in the moments, when everything goes wrong and the company you trusted for 11 years picks up the phone and reads you the paragraph you forgot to read when everything was fine. So tell me where you land. Do you think the insurance industry is a flawed but necessary system that basically works for most people most of the time? B, the entire model is structurally predatory and needs federal regulation with real teeth. Or C, you have personally had a claim denied and are currently typing something much more specific into the comments. Drop it below, because the fine print only wins when nobody talks about what is actually in it.